What is mortgage insurance? I'll give you the stiff definition of it, and then I'll kind of give you the practical definition of it afterwards. But it's insurance that's required by individuals who are purchasing homes who have less than 20% to use as a down payment. And it's ultimately insurance that protects the bank against you not making your payments. And I know some of you might be thinking, oh, well, I'm always going to make my payments. I'm getting this mortgage because I fully expect to get my payments. And that's great, but the reality is that people do default on their mortgages. And because mortgages are such an important cornerstone of the economy, mortgage insurance helps to make sure that more people have access to mortgages, and ultimately that banks are protected in the event that someone who doesn't have enough of a down payment based on the bank standard can still get home ownership is still something that would be accessible to them. So much like an insurance policy, there's a premium. That premium is added to your mortgage amount, and so you might find that if you're purchasing a home and your mortgage is a couple $100,000, that you're going to have this extra amount added to it, which is ultimately insurance that if in the event you stop making payments, the bank is able to make sure that they don't take a loss on your mortgage. A quick little side note here, mortgage insurance is not the same as mortgage life insurance. And so a lot of people confuse the two. Mortgage life insurance would be your mortgage being paid off in the event of your death. Mortgage insurance, as we're talking about it today, is to protect the lender against you not making any payments. So the backstory, thanks to Wikipedia and my own interactions with various people in the marketplace, but basically where mortgage insurance came from was just at the tail end of the Second World War. The government was concerned about all of the soldiers that were going to be returning back to Canada, and that there would be a shortage of housing for them and their new families. And so there was a Crown Corporation, or a government corporation, that was created to start putting up communities in various parts of Canada. But at the same time, these new homeowners didn't have enough of a down payment to be able to purchase these homes. And so because of that, the banks in essence said, look, we can't just lend money to people that don't have enough of a down payment. Normally, it was common practice that someone would save up for half of the price of their home, then they would be able to go to the bank and get the other half. And that was kind of the standard. But when these soldiers were returning back from World War II, they obviously didn't have those sorts of financial resources, and the bank said, well, we don't know how to fix this problem because we can't take on the additional risk of lending people more money than what we're prepared to lose. And in the event that we lend them the money and we lose it, that could have bigger financial implications across the market. So the government said, well, tell you what, we'll provide insurance. So if somebody meets a certain criteria, banks go ahead and lend them the money. We'll charge them an insurance premium. And in the event that we've collected enough of these premiums from all of these homeowners, that in the event that any of them default, there would be enough money in the pool to make sure that you, the bank, don't take any losses. And so that's kind of where mortgage insurance came from. It was meant to help give more people access to home ownership who didn't have enough money to meet what was then the bank's requirement for how much down payment you needed. And again, it was normal that if you're going to buy a property, you would save up half of the purchase price, the bank would lend you the other half. But because these returning soldiers in the marketplace in general, housing prices has started to go up because of supply and demand, and people just found, look, I don't have half the purchase price. I don't have 50% to put down. I have 5% or I have 10%. But the banks weren't prepared to lend to those particular individuals. So the government stepped in with an insurance program called CMHC, or it evolved into CMHC, and it was basically designed to protect the banks in the event that someone who had less than a certain amount of down payment, if they didn't make their payments, that the bank would get a payout from the policy. So that's mortgage insurance, and I would encourage you to check it out. The story is actually quite interesting of how it evolved in Canada. There are similar stories of what happened in the United States, but for us Canadians, what we're focused on is how it happened here. And so check it out on Wikipedia. We'll post the link on our Twitter feed in case you are interested. And anyway, so that's what mortgage insurance is.